Hi, everybody. My name is Nathan Dean. Again, welcome to the Bloomberg Intelligence Financial Policy Weekly call, coming to you from the Washington, D.C. Bureau. What I want to do today is just briefly run through some of the key things that have happened last week. But before I do, just a little administrative note. If you have signed up for this call, for last week or prior to last week, we didn't give you the option of signing up for my newsletters. So if you want to sign up for the newsletter, please email me at ndean10@bloomberg.net. And the reason being is that if there's ever a chance or if there's ever a reason why somebody's sick and I don't make the call or whatever, I will be using that newsletter distribution list to just remind you and make sure that you don't show up. However, if for some reason I don't show up by 5 minutes after the hour, university rules apply, professor is not there, feel free to walk and we'll catch you up on the next one. But I'm pretty sure, I really hope that I don't have to do that or waste your time like that. So let's just talk about what happened over the weekend. We have a deal in the Senate when it comes to the border security Ukraine-Israel package. Let me just run off the top line numbers real quick. It's a $118 billion package, about $60 billion for Ukraine aid, $14.1 billion for Israel, $2.44 billion for ongoing operations in the Red Sea, $10 billion for humanitarian assistance for Gaza and the West Bank and Ukraine, $4.83 billion for Taiwan, $2.33 billion for Ukraine refugees, and $20.23 billion for operational needs at our border. Now, there's a little bit more in there, but what I want to say just for the get-go is that at Bloomberg Intelligence, we're mostly focused on that Ukraine number just because of the impact on the defense contractors. Now, when President Biden had originally said he wanted $43 billion way back in the day, we did a little bit of analysis saying that that was going to be a 1 to 2% increase. I think I mentioned this on last week's call. We're going to be rerunning those numbers for this $60 billion package, and we'll also put out our views on whether or not this will pass. Now, I don't want to get into the weeds just on that too much because we're going to do that we're going to put that research out this week, but just remember, Speaker Mike Johnson said last night, this thing is dead on arrival in the House. We've even seen statements from like Senator Menendez in New Jersey on the Democratic side saying that blasting this, saying that this doesn't go, that this just doesn't work. So you can take it one of two ways. One, there are too many people that just do not like this bill, so it's going to fail. Or you could take the approach that too many people don't like this bill, so there actually is some chance to it. Now, which side is right or wrong? We're just going to say right now that we don't think there's anything here that is forcing Congress to make a decision until April 30th. And so don't be surprised if in February you continue to see just headline after headline after headline about this not really working or we're working. There's really nothing here that they have to do this by a certain date until April 30th when that 1% sequester comes in. So stay tuned. This is going to be a lot of, we're just in the first step of a very long process here. Other things I want to talk about, well, we actually put out several pieces last week on the Inflation Reduction Act. So we're getting a lot of questions from clients at the moment of what happens to the Inflation Reduction Act if President Trump wins in November. Now, I have colleagues like Dwayne Wright writing about healthcare, Justin Tracy talking about electric vehicles, Andrew Silverman talking about tax, if you will. I put out a piece just talking about the political process of it. So here's what to think, is that if President Trump wins in November, will there be a full repeal on the IRA? No. We have an extremely low odds of that, around 20%. The reason being is that the Democrats use this process called reconciliation to get this package to the president's desk. And I don't want to get into the technicalities of it just because I could do an entire call on that, but I don't see the Republicans using that same reconciliation process to repeal the IRA. And just note, you would need a Republican House, a Republican Senate, and a Republican presidency. Now, on the other hand, if President Trump does win, he can certainly use a scalpel to target tax incentives and tax breaks. This could even come on day one of being in office, executive orders. If he were to win, you would probably see a whole host of executive orders he could write, essentially saying, Treasury Department, I need you to cut back on these tax incentives, go forth. Now, it's a little too early to tell exactly which ones are the ones that are up for risk. When the Republicans tried to repeal several of these tax provisions before, they just ran the gauntlet and said, we're going to put out a bill that tries to repeal them all, and then obviously it doesn't go anywhere. But there is a website on the IRS website that lists out all these tax incentives as part of the IRA, and there's a clean energy there's a clean energy section there. So if you are exposed to this industry, solar, electric vehicles, utilities, and so forth like that, have a look around, see if any of those tax incentives are the ones that are actually flowing into investment into your companies. Give us a call. We'll be happy to talk about that. And we're going to be putting out a lot more research on this over the next few months. This is just the beginning piece of it. Other thing I want to put out on the Commodity Futures Trading Commission, they have put out a request for comment on artificial intelligence usage within derivatives. Now, the CFTC is joining the SEC and the financial regulators in looking at this, but what we're telling our clients is that when it comes to AI, not just in the financial regulatory space, but for pretty much all of Washington, they just don't know what's going on. I mean, Washington is not your tech hub. I mean, yes, we have Amazon and Google and HQ2, the down in what they call National Landing now. We still call it Crystal City or Pentagon City, but Amazon wants us to call it National Landing. But we have tech companies around here, but for the most part, Washington still just doesn't really understand what's going on here. So, the CFTC is just reaching out for comments. They're literally saying, hey, help us try and identify how AI is being used in the derivative space. The SEC has a proposal out there on predictive analytics and AI usage, but essentially what you need to know about financial regulation and AI is that the examiners and the bank examiners and the SEC and the CFTC, they're going out to the firms that they oversee, and they're essentially saying as a first step, show us what this AI does and make sure to ensure that this AI adheres to existing regulations. So not new rules or anything like that. We just want to make sure, for example, on the SEC side, is it adhering to regulation best interest? Are you giving customers the appropriate disclosures? Are you putting enough protections in place? Are your third-party relationships, the fintech firms that you're working with, are they protected from a cybersecurity angle? So anytime you see a financial regulator get into AI, if you will, just think, you know what, it's probably going to be increasing costs. If you're on the compliance side, if you're on the risk side, you're certainly going to have to pay attention to this more. You're probably already paying attention to it already. If you're on the front office side and you're trading off of this information, just keep it in the hip pocket. It's not all that material in terms of share prices or anything like that. So just a couple other things to note what's going on. Tomorrow, we're hosting a webinar on marijuana, our global cannabis outlook for 2024. If you want to attend, if you're exposed to MSOS or YOLO, or if you're just in the marijuana space, give us a call. I'll send you the link after this. You can please, it's free to join and so forth. I'll be talking about DEA rescheduling and the Safer Banking Act. Just the DEA rescheduling. If you are in this marijuana space, just note, we do say that there's a 70% chance that DEA will reschedule marijuana this year. I think it'll be a political decision. I can talk about that more on the webinar tomorrow. But as you've seen with these marijuana equities, my colleague Eric Balcuna says that anytime he looks at a equity where it bounces in volatility, he says it's got hot sauce. I like that term. These marijuana equities have hot sauce on them. I mean, they jump up 15%, they drop down 15%, up 20, down 20, and so forth like that. You're going to see some political catalysts over the next year for the marijuana space, certainly something to keep an eye on. Other things to note, the OCC put out a proposal on bank mergers. I'm going to have my thoughts on that probably out later this week or the beginning of next week, but my colleague from Bloomberg News, Katanga Johnson, put out a great piece talking about it, and just fits this general void or this general idea that bank mergers are extremely hard to do under the Biden presidency, and what could that mean under a Trump presidency and so forth like that. I'll have that out next week. So a couple other things happening this week. February 6th, the SEC is going to finalize its Treasury market dealer rule. This was actually supposed to happen last week. It got punted to next week or this week. And then also on February 6th and then February 8th, Secretary of the Treasury Janet Yellen is going to testify to the House Financial Services and the Senate Banking Committee. Now, this testimony is geared towards the annual oversight report of the Financial Stability Oversight Council. So, yes, obviously there will be monetary policy questions asked. Yes, there will be economic questions asked, so forth. But from my standpoint, in what I cover, I am most interested in what Secretary Yellen has to say about non-bank SIFI designations and this rise of private credit, if you will. Now, just to give you a little bit of background, back under the Obama administration, there were 4 non-bank SIFIs. And over a variety of years, or over a number of years, for a variety of different reasons, there are no SIFIs today. Now, what happens if you're a non-bank SIFI? Well, you get enhanced prudential standards, capital requirements. Essentially, it's going to drive your costs dramatically up, and it's going to put you under a much more rigorous federal oversight. Now, what happens in this situation? Well, the Yellen-era Treasury Department rescinded a Trump-era guidance that would have made it harder to deem a company a non-bank SIFI. Now, so I don't think you're going to see any non-bank SIFIs in 2024 or 2025, but if President Biden wins a second term, Treasury is certainly looking at this. And what I want to see from Secretary Yellen, and I think you'll get this probably in the House Financial Services Committee, because she'll be talking for about 4.5 hours versus the Senate Banking, which will probably go around an hour and a half to 2, is whether or not Treasury is still looking at this. So a lot of things to keep in mind there. If you do want to talk shop about those committee hearings, we'll be watching those, and feel free to reach out. So I'm going to leave it there. Thank you again very much. And again, if you want to join that newsletter, it's ndean10@bloomberg.net. And if you have any questions or anything like that, please feel free to reach out, and I wish you a great day. Thanks. Bye.